Hello everyone and welcome. Now in today's video I'm going to be taking a look at the New Zealand top 50 charts to see what's been going on in the market over the past week. And we're going to look for 3 New Zealand companies that have the potential to do well in this bear market. Now, it is not a surprise that bigger companies tend to do better than the medium and smaller companies during a bear market. This is simply because they have more capital to take on debt and survive these difficult situations. But what I'm going to do is I'm also going to look through the balance sheets of the companies, and we go through the PE ratio, the return on equity, the debt to equity ratio, the current ratio, dividend ratio, and the payout ratio to see if the company is doing well financially. Let's have a look at the current New Zealand top 50 charts to see what's been happening over the past week. As we all know, we had a huge sell-off in February where we hit a low, and then over the past month we had a big rally all the way up to around the $2.80 mark. But since then, after the news broke out that we're going into level 3 lockdown, the price of the New Zealand top 50 has just been chopping around in this region. Now, if we want to be a little bit more specific, we can plot out the Fibonacci retracement from the previous high in February all the way down to the lows in March. So we're kind of chopping around the 61% mark and the 50% mark. So basically we're kind of just bouncing around within this region here, and it'll probably take some new stimulus, either good news or bad news, for us to break out of this particular region. Now, I believe once the reality of the loss of income and jobs from the tourism and hospitality sectors have set in, we are potentially heading for more downside again. So overall, at the moment, it might bounce around a bit, but overall, I am still bearish within the current market. So what do we do in this situation? What are some of the good companies with a solid financial background to be able to weather the storm? And this is what we're going to look at in this video. The first company that we're going to be looking at is Spark New Zealand, denoted by the symbol SPK.NZ. So Spark is a telecommunications and digital service company in New Zealand, and it offers telecommunication, IT, media, and other services. And their service include mobile phone, broadband, internet TV, and cloud service and management. Spark also has a retail branch for the telecommunication products and services, and also distributes equipment for setting up the mobile cellular network. As the world becomes more digital and people have online meetings and online classes, and more people start to learn and work from home, Spark is in a good position to be able to provide a lot of the services that people will need. The first thing that we're going to look at for Spark is their PE ratio. So Spark has a PE ratio of 19.07. And P ratio stands for the price to earning per share ratio. What does this mean in layman's term? So if a company has a P ratio of 20, it means that you are paying $20 in terms of the share price for $1 of the company's earning. Another way to look at it is if you flip it around, you get $1 for every $20 that you pay. So effectively, you're getting a 5% return. P ratio is also very misleading because different sectors can have very different P ratios. So you should only compare P ratios within the same sector. But in this situation, Spark has a pretty decent PE ratio compared to other companies within its sector. So we want to look at the statistics of Spark. One of the first things that I will look at here is the return on equity of the company. So Spark has a 29% return on equity. Basically, a return on equity is the net profit of a company divided by its shareholders' equity. What this means is that for every dollar that the shareholder invests, the company is able to generate 29 cents out of every dollar. So this is an indicator of how well a company is able to utilize the money that it has. So basically, in this situation, the higher the return on equity, the better. And in this situation, it has a return of 29%. And for a lot of companies, if you get more than 20 or 25% return on equity, it is considered a very good return. The second thing that I will look at here is the current ratio of Spark. So current ratio is basically the liability divided by the assets of the company. And you want this value to be above 1, which means that the company has more assets than their liability. And the next thing that we want to look at here is the dividend yield of the company. So Spark has a dividend yield rate of more than 5%, which makes it a fairly good option if you are into dividend investments. What I will also note here is that Spark has a very high payout ratio for their dividends at 95%, which means that 95% of their net income is paid to shareholders in dividends. Now, a very high payout ratio might become a problem because the company might not be using enough actual cash to actually invest in infrastructures for the future. There are some companies that have a payout ratio of over 100%, which means that their dividends are actually more than the income that they're getting. And this is completely unsustainable in the long term, because in order to do that, a company may need to take on more debt to be simply able to pay out the dividends to their shareholders. Let's have a look at how well Spark is doing in comparison to the New Zealand Top 50 this year. So Spark has been doing slightly better than the New Zealand Top 50 from the beginning of the year. And I will consider Spark as a fairly consistent company if you want a decent source of dividends. But you probably won't expect too much growth from this particular company. The second company that we're going to be looking at is Fisher & Paykel Healthcare. So Fisher & Paykel Healthcare designs, manufactures, and sells medical device products and systems. And the systems are used in respiratory care and surgery, as well as treatment for sleep apnea. So the first thing that we'll notice for Fisher & Paykel Healthcare is that they have a relatively high PE ratio of 70.22, which means that effectively you're paying $70 in terms of share price for $1 of earnings. This may mean that the investors expect a high potential growth for this particular company, so they are willing to pay a higher price for the stock itself. If we look at the statistics of the company, we can see that Fisher & Paykel Healthcare has a return on equity of 27.49%. Again, when you have a return on equity of more than 25%, it is considered that the company is very good at generating income for the company. Down here, we can see that the company has a current ratio of 2.06, which means that they have more than twice the amount of assets as compared to their liability. In terms of dividends, Fisher & Paykel Healthcare does not have a very high dividend yield. So they have a dividend yield of around 0.9%, which is a lot less compared to the previous company, Spark. Their dividend payout ratio is 57.3%, which means that they could still be potentially using a lot of the income they have generated into the future growth of the company. Now let's have a look at the chart of Fisher & Paykel Healthcare compared to the New Zealand Top 50 from the beginning of this year. So this blue line is the New Zealand Top 50, and New Zealand Top 50 has lost more than 9% from the beginning of the year, while the Fisher & Paykel Healthcare have gained more than 27%, which means that this company is performing well above the average of the New Zealand index. Overall, I will consider Fisher & Paykel Healthcare to be a good company to invest in because of the field that they're in, because in the bear market you still need medical equipment and the potential growth of the company. The last company that I'm going to be looking at is A2 Milk Limited. So A2 Milk sells milk powder and its related products in Australia, New Zealand, China, and many other Asian countries, and even in the States and the UK. So they have been the biggest company in New Zealand in terms of pure market cap. So the first thing that I would notice here is, again, the P/E ratio of the company is 44. Again, this is a reasonably high P/E ratio compared to its peers, like the other companies that also produce the dairy products. However, the P/E ratio is that high because a lot of investors believe in the future growth of this particular company. So let's now dig into the statistics of A2 Milk. We can see that in terms of return on equity, A2 Milk has a massive 39.66% return on equity of its investment, which is absolutely amazing. It's considered extremely high. Now, the other things that we want to note here is that unlike many other companies, they have a debt-to-equity ratio of 0.77. This means that unlike many other companies, A2 Milk actually has more equity than they have debt. So even if the market completely shuts down, they're still able to completely pay off its debt. And this is an extremely good situation for the company to be in. They also have a current ratio of 4.14, which means that they have more than 4 times the amount of assets as compared to their liability. Now, looking at their dividends, they do not pay out any dividends, so they don't have any dividends or any dividend payout ratio. So if you are looking to hold this particular company shares, you are purely looking to invest in terms of share growth. The company may also not be paying out dividends because they are more focused on investing its income to grow the company further. Let's have a look at the charts that compare the A2 Milk share price with the New Zealand Top 50. So again, in blue, the New Zealand Top 50 lost about 9% from the start of the year, whereas A2 Milk gained almost 30%. This goes to show that A2 Milk has not been significantly affected by the current recession. Is it a surprise that the 3 companies that are doing extremely well are the top 3 companies in the New Zealand Top 50? Well, it shouldn't come as a complete surprise, because of the sectors that these companies occupy, and they are the ones that are least affected by the current economic downturn. I hope I have pointed out why I think these companies have the potential to do well financially. And as always, past results does not indicate future success. And please do not take this as financial advice to buy or not buy a particular company. Make sure to do your own research before making any investment decisions and consult your financial advisor. Be sure to like and subscribe and all that good stuff, and I will see you in the next video.